In 8 days, the same barrel of oil went from nearly $90 to under $70, and then started climbing again. Same barrel, same week. Almost nothing moves markets the way oil does, and right now the entire price is hanging on a strip of water about 35 miles wide. By the end of this, you'll know exactly what to watch to see which way it breaks. Quick ground rule for this channel. We don't give advice, and we won't tell you to buy or sell a thing. We map what's happening and the ways it could break. So let's map this one. This is the Strait of Hormuz. At its narrowest, the shipping lanes are just a couple of miles wide, and through them moves about 20 million barrels of oil a day, roughly a fifth of the world's oil. There is no quick way around it. The handful of bypass pipelines can carry only a fraction of that volume. So anything that even threatens this strip of water gets repriced into oil almost instantly, and from there into everything else. That's what makes it a choke point, and not just a shipping lane. Here's why an economist watches Hormuz and not just the oil rig. Oil isn't only fuel, it's an input into almost every price in the economy. The cost to ship a container, to make plastic, to grow and move food, to fly a plane. So when crude jumps, inflation expectations jump with it. And when inflation expectations jump, the pressure on central banks to keep interest rates high jumps too. There's a piece of this that trips people up, so let's be precise about it. Markets don't wait for the oil to actually stop flowing. They price the probability that it might. Traders call it a risk premium. A few extra dollars baked into every barrel, just for the chance of disruption. That premium can appear in an afternoon on a single headline and bleed back out just as fast when the headline fades. A lot of this week's wild round trip wasn't barrels changing hands. It was that premium inflating and deflating. And this week, that chain runs straight into a Federal Reserve that has just turned more hawkish. Inflation is already near a 3-year high, lifted by tariffs and the war. At his first meeting, the new Fed chair held rates steady, but dropped the language about cutting, hinting the next move could be a hike. So oil is no longer just an energy story. It's the swing variable in the inflation story. And the inflation story is what the Fed is reacting to. Watch what happened when oil actually fell this week. You could see the relief move through the market in real time. Airlines, which burn fuel for a living, jumped. United up about 7% in a session. Home builders rallied as bond yields eased. The 10-year Treasury yield slipped to 4.37%. Cruise lines, trucking, and ordinary households at the gas pump, all quiet winners of cheaper crude. The losers were the mirror image, the energy majors and oil producers, the companies that need crude high. So read the tell carefully. This isn't really a story about oil companies. It's a story about whether cheaper oil quietly cools inflation and lets rates drift down, which lifts almost everything that isn't an oil producer. For a few days this week, that's exactly what happened. And this lands at a delicate moment for the stock market. The same week oil was swinging, money was rotating out of expensive AI-driven technology names, the ones that have led the market for years, and into exactly the rate-sensitive corners that benefit from cheaper oil and lower yields. Airlines, home builders, healthcare, banks. That's not a coincidence. When oil eases and yields fall, the math on a richly valued growth stock gets a little worse, and the math on a beaten-down value stock gets a little better. So oil isn't just moving energy prices this week. It's quietly helping decide which half of the stock market is in charge, which raises the stakes on every headline coming out of that strait. So here's our base case. The most likely read, not a prediction. Oil stays the market's swing variable, trading tick by tick on headlines out of one strait. A fragile U.S.-Iran truce keeps a risk premium baked into the price, a few dollars of what if. But reserve releases and tankers that are still moving keep an outright supply shock at bay. The result? Choppy, headline-driven, emotionally exhausting, but contained. No spike to the moon, no collapse to the floor. That's the center of the road. Now, the two things that knock us off it. The bearish flip is the obvious one. The truce fails in a way that actually touches the water. Mines, a seizure, a closed lane, and 20 million barrels a day cannot simply reroute. Crude spikes, possibly hard. That pushes inflation expectations straight back up, which hands that already hawkish Fed a concrete reason to hike rather than wait. And a market that is also nervous about stretched, AI-driven valuations now has two problems at once: more expensive oil and higher for longer rates. In that world, the rotation we just walked through runs in reverse, and the relief rally gives it all back. But it can break the other way, too. If the talks underway in Doha produce something binding, that risk premium drains out of the price. Layer on what some analysts are already flagging: pockets of oversupply, strategic reserves released, tankers quietly clearing the strait. And oil could drift lower from here, not higher. That's the disinflation path. Softer crude, a calmer inflation read, and room for the Fed to ease off the brake. It is the exact opposite trade. And notice it depends on the same strait, just pointed the other way. And if this feels familiar, it should. Hormuz has been a market flashpoint for decades. The pattern repeats. Tension flares, a risk premium floods into oil, and then, most of the time, diplomacy or fresh supply quietly bleeds it back out. Markets have a memory of that pattern, which is exactly why this week's drop came so fast. Traders have learned to fade the panic. The danger in leaning on the pattern is simple. It works right up until the one time it doesn't. So we don't pick a winner, we watch the tells. 3 of them. 1. Tanker traffic through Hormuz. The ships tell you more than the headlines. As long as they keep moving, the supply shock isn't real yet, whatever the cable news says. 2. Whether the U.S.-Iran talks in Doha produce anything binding or just another pause. A signed framework drains the premium. A stalemate keeps it. And 3. This week's U.S. jobs data and the Fed's next inflation read. That is where oil's move actually shows up in policy. And policy is what reprices the entire market, not just the energy aisle. Watch those 3, and you'll see which path we're on before the price fully tells you. 35 miles of water, a fifth of the world's oil, and an entire market's inflation story riding on whether the ships keep moving. We don't know which way it breaks, and anyone who tells you they do is guessing. But now you've got the map, and the 3 tells that move before the price does. If you want the clear-eyed version of what's actually moving markets, the base case, and what flips it, subscribe. New read every week. Crosswind Economics.